Good morning and welcome to the Saxo Bank Morning Call. It is Thursday, April 25th, 2019, and we have markets showing some interesting behavior. I think some signs of really a lot of cognitive dissonance, I would argue, Ole, both in commodities versus stocks and equities, stocks and bonds. But let's dig into it. I mean, first chart we have here is this Nasdaq roaring to a new high for the cycle. The Facebook and Microsoft results pumping up the market there, and we have a couple of big names out today as well. Amazon and Intel, and I think interesting on the semiconductor front. I don't follow earnings all that closely, being the FX strategist, but we do have some of these semiconductor companies not reporting that great results, but they're just continuing to charge higher. So this is the big one. Intel results today could be interesting to see if this trend can continue. And Ole, you wanted to point out something on the VIX side of things. We've talked a lot about the melt-up scenario. Yep. Stocks just continue to grind higher. Of course, we're seeing a lot of volatility selling on this.
Absolutely, because traders right now are looking for return and looking for yields. They're once again attacking the volatility curve. Just brought a couple of charts here. What we can see is that as the volatility comes down, we also tend to see that the contango goes up. That basically means that the volatility is lowest at the front of the curve. That basically means if you are short volatility, you're making money not only on the fact that the volatility is coming down, but also that you're rolling into a higher volatility every month that you are buying your short back. And that basically means that speculators has been rushing back into VIX short positions. You can see that's the latest data from on the CBOE VIX future, and we hit a record short last week, a bigger short than what we saw back in early 2000 or late 17, early 2018. Remember that big spike we had high in VIX back then? It wiped out a few ETFs.
Just to point out, I'm trying to interpret your chart here. That net short is the yellow line, and that one is the one that's at the new low there. So
that is correct.
Yeah, okay,
that is correct.
Cool.
The yellows are the nets. So just to show that what happened when we saw that blow up in volatility. Not we're saying it's going to happen, but obviously just have to be a little bit nervous when we see the market start to get so one-sided. We did see a 93% drop in that SVXY. It has obviously recovered quite nicely over the last couple of months because again people are once again riding it, but we can see how terribly it can turn out.
I think anybody who reads Taleb would know what's going on there. So the black swan hitting in volatility terms, and becomes the important thing becoming as the market gets too one-sided, the risk actually rises of the volatility event being that much more violent. Interesting there. The other interesting thing I think is we've talked about this melt-up scenario, the idea that the support of central banks, maybe a growth rebound, are going to support a melt-up in equities again because the central banks simply don't want to push back against the markets. But I think one of the things that would be required to confirm this was those longer U.S. yields. We talked about this last week or the week before that. It's been a while since we've had the morning call, and talking about the key being sort of maybe the middle to longer term yields in the U.S. and whether these can continue higher if you're looking back at what happened in 1998 when the Fed sort of panicked over LTCM and perhaps the Asian financial crisis. So look here at our U.S. 10-year benchmark. We had a very strong U.S. 5-year Treasury auction yesterday, and yields pushing significantly back lower. Look at that red line. That was where the sort of the lows in the yields stabilized after the huge collapse in yields in Q4 of 2018. And to me, a sign, a pretty strong technical sign of support for the bond market, and that support yesterday pretty profound. And really an off note, if you will, relative to what's going on in the equity market. So one of those markets, to me, has to be wrong, at least in my world. I have a hard time seeing both bonds and stocks going stronger right here. And if we look at another thing that is very confusing, and I think that pushes back against the stronger equity, stronger risk appetite narrative, certainly worldwide, and that is a stronger dollar. We're seeing big moves in the dollar. Yesterday, we've seen a pretty decent, solid, and broadening firming of the dollar. But yesterday, a decent break happening. Look at the chart here of euro dollar, really sort of ripping below that 112 level. Have to have been a lot of orders involved there. Do note, however, we saw back in November last year, a one-off strong sell-off that was recouped, and then the one in March that was around the dovish ECB, a one-off strong down move that was a one-day wonder and sort of backed up into the range. So really key to see, in other words, that the break is the break, and then we see some follow through here. A couple of holdouts, as I'll point out here as well, are we've seen dollar strong across the board, but dollar yen not quite there yet. That's the lower right-hand corner. It tried yesterday ahead of the Bank of Japan overnight, That meeting really not bringing anything of interest, if you ask me. You can read Google a couple of articles, but the key thing being Japan is out on holiday for another week plus. And then the Aussie, of course, we've seen a very dramatic fall there, driven especially by the weak CPI data this week. But that 70 level, just a massive one. Look at that, how far back that goes into 2018 in terms of sort of a weekly close. We saw that brief spike on the flash crash linked to yen crosses, but these are sort of the last holdouts. So, your dollar falling through lower and dollar, and then these other key levels breaking. What is the driver? I think it's just the world is short of dollars, and perhaps the realization that the Fed really needs to be going into full-on easing mode to see a weaker dollar here. And then another one, gold. You wanted to point out gold is quite interesting relative to what's going on in the currency market, because the gold is actually not that weak if you look elsewhere.
That's true, John. And I was just again, it's been a while since we've been here, and obviously quite a bit have happened. And if you look at the chart, you can see how gold has broken down over this past week. But you would imagine after that, there's a lot of people talking about head and shoulders and so on below 1276. But we're really hanging in there, and you can see also that in the minor chart, small chart, which is gold priced in euros, is actually been picking up over the last day. So even though we got the dollar strengthening, gold is not really playing ball in terms of weakening further. It does indicate that even though we have stronger stock markets making new highs, we got the dollar making highs as well. Gold is still holding in there, so it does indicate there is some underlying demand still in the market. And I think also it's worth pointing out that speculators have once again turned net short. So again, if there is any change now in the fundamental or technical outlook, then there is a lot of buying to be seen in the market. So just holding on at least for now.
Yeah, so I would suspect if we do see those a strong support coming in for treasuries, safe haven seeking, and we were to see equities melting down, I would suspect that gold would do rather well in broad terms. But that's I think the interesting thing to point out today is just these sort of this dissonance across markets and trying to interpret which one is correct. Another one's oil. I mean, oil is providing massive pressure on the whole growth story. Because
I was just about to say, we have to remember what happened before the big sell-off in stocks last year. That was the huge move up in oil towards 85. Because the market was worried about the U.S. sanctions against Iran removing too many barrels from the market. We're having a repeat situation once again. So not saying that we're going to have this is going to lead to another stock market sell-off, but at least it was the precursor for the sell-off we had last December. But take a look at the chart here. You can see how we made it back up to 75. It's been a non-stop rally more or less all year. We're back into that consolidation area we had last year between 70 and 80, and it's basically geopolitics have once again hijacked the market, so it can go anywhere. And just look at the dilemma that I highlight there. Saudis, they're cooperating with the Russians to cut production. They've been doing that since November or December last year, and now at the same time US seeking Saudi cooperation to increase production. How that's going to end up, only time will tell. But what I think is for certain is Saudi Arabia is not going to jump this time when US asked them to jump, because last year they jumped, US didn't deliver, and the market collapsed. So this time around they're likely to wait to see the impact on the market, or see how successful US will be in cutting production from Iran.
And then in terms of positioning, you do these great reports on positioning oil. You've got in your noting that there's people piling into this energy move, and apparently out of the grain sector. Yeah,
it's not a surprise that we're starting to see some stretched markets here. You can take a look at the chart here. You can see that we are into overbought territory across some of these major crude oil markets. We did see a slightly bearish energy weekly report yesterday from the EIA that may just cap the market today. But overbought in energy, and then look at the whole space down in the agricultural. We got a record short in corn. We got RSIs being put under pressure. Weather in the US is behaving. We're once again looking for a bumper crop. So we really need a change in the either dramatic change in the dollar in terms of weakness, or we need to see the weather.
Despite all the flooding and all this, it's not impacting the outlook.
It has not impacted enough to impact the market. So just to keep this in mind, just from a technical or fundamental, if there's any change in the current outlook, then there is a big short. There is a very oversold market that needs to respond to that. Same goes for the energy market.
Right. And onto our calendar, I do not have the earnings on there, but we do have Amazon and Intel up today. We also have, also not on the calendar, a 7-year auction. The Treasury auction's picking up a bit of interest. I think that is the most interesting market as a sort of the one that provides more information on where we're headed next. If we continue to see lower yields in the U.S. at the long end of the curve, I'm really struggling to see a strong risk sentiment scenario. Stronger dollar also providing pressure on global risk assets. We're seeing that across EM. That's not what's on our calendar, but let's look at what is. We have a Riksbank interest rate announcement up shortly, and Stocky's actually at an interesting spot here, having risen, actually having weakened. So Euro Stocky rising, dollar Stocky at very interesting levels as well. People are struggling to see how the Riksbank maintains a rate hike bias and neutralizing rates with the ECB, so struggling down at zero and negative rates and not seeing any change in their outlook. So I think the market's really going to key off of that. One interesting thing to note, I would argue that we've seen the Norwegian central bank with its rate hike cycle, and you're not really seeing that much of a response in the Norwegian krone. It's not. It's of course it's appreciated against the euro, but considering how much the curve has risen relative to the European yield curve, and considering how much oil prices have risen, we've talked about today, Euro-NOK is in a very odd place relative to those moves. And I would argue that even if we do see a rate hike from Riksbank trying to declare victory by having or insisting they are going to continue to hike rates and achieving that zero interest rate again, I think the outlook beyond that is going to be rather flat. Hard to believe that Sweden can continue to go on a rate hike cycle without the rest of the world or the rest of the Europe following suit. Back to our calendar, we have also Turkey up, a key EM, and one that's going to be increasingly under pressure if global risk appetite and liquidity starts to deteriorate from here. Those weekly jobless claims from the U.S. at 12:30 GMT. This is interesting. We've seen a couple of record low prints if you adjust for population size in previous weeks, and then some other various data. I think the interesting one for the rest of the week being, however, the U.S. GDP estimate tomorrow. I've not highlighted that in red, but that's the key one for tomorrow, I think, on the sentiment for growth and maybe for the U.S. relative to the rest of the world. So lots to chew on here, lots of interesting sort of dissonance across markets and where we're supposed to extract information value from those will be very interesting, I think, in the sessions ahead. That's it for today. We'll be back tomorrow with the Saxo Bank Morning Call. Thanks for joining.